try to have a portfolio they can earn a maximum return on. One is by acquiring other REITs or other properties. There's a lot of that because REITs don't own all the properties.
I'm here with one of the top dividend investing minds out there. His name is Roger Conrad, and he is a friend of BBA. He's done videos with us before. He's probably best known for his utility expertise. Even my dad, who's a utility guru, really respects Roger Conrad. But today, he's going to talk about a different stock idea, something in the real estate area. So before I say anything more, Roger, welcome.
Thank you for having me.
Always a pleasure. And you are substance over sizzle in my mind. You really, really know your stuff. As we were just chatting before I hit record, I wish the whole world knew how much you knew, and hopefully this video helps in some teeny tiny way. You told me just before we started talking, you've got a REIT, a real estate investment trust, that you think people might want to take a look at today. Can you give a 30-second or 1-minute intro to REITs for someone who's new to investing?
Okay, so REITs basically own property, or most of them do, and you can own different kinds of property by owning different REITs. They've been around, I guess, about 20 years. The idea is that you can, as an individual investor, get the benefits of property, which is income, basically through a dividend. They pay out most of the income that they make, they pay out in dividends, and also the benefit of property appreciation over time. And a well-run REIT will do that, both of those things. Again, you can buy and sell it just as an ordinary stock. So it's a convenient way to buy. It's become kind of a mainstream industry. They're actually all over the map in terms of what you can buy. It started out, it was just apartments, offices, shopping malls mainly. Now you can buy, farmland. You can buy medical properties. The one I want to talk about is a residential property REIT, and it's a sector that's been within the REIT sector, which has been kind of knocked down. It's been pretty much unloved over the last few years, really, more than that. And this is a sector that's particularly unloved within that sector.
Well, I love the unloved, and just on REITs, generally they buy and they operate versus buying and flipping, right? They tend to hold stuff for a while. Is that accurate anymore?
Well, yeah. I mean, what REITs will do is try to have a portfolio they can earn a maximum return on, taking out the expenses and so forth of running those properties. So they grow their earnings basically, I guess, in three ways. One is by acquiring other REITs or other properties. There's a lot of that because REITs don't own all the properties in the country. So that's a major driver of growth, particularly for things like self-storage, the self-storage business. You have construction, so they'll go out and build new buildings and so forth. And there's some areas where that's completely gone beyond the boards, such as office. We're not really building a lot of new office properties, except in some sectors like life sciences, for example, which are laboratory spaces. Those are in demand. But just your conventional vanilla office building, owners are talking more about selling, or they're talking more about repurposing. So that's two ways, building. And then the other way, of course, is rents. If they can raise rents over time, and a well-run REIT with high-quality properties will be able to do that, at least at the rate of inflation over time. So those three ways push up the cash flow that REITs will get, and then they can in turn distribute more of that to shareholders.
Got it. So the VNQ, the Vanguard Real Estate Index ETF, is just barely up, 2.3% so far this year, which is underperforming the S&P, as you noted. But the company that you mentioned just before that we started recording, Mid-America Apartment Communities, MAA is the ticker, is up 12% something so far. So it's doing a lot better this year. Can you tell us why you like it?
Well, I like it first off because it's a very well-run company. It's got a very long-term pedigree. It's had a really good strategy, which is basically expanding in the Sunbelt, where people have been moving. So they buy basically high quality, or build rather, high quality properties. They're mainly a builder. So
Mhm.
they build properties. They also have been very successful taking properties that they have been in operation for some years and upgrading them. So therefore, they've been raising rates. So we call that basically what's called organic growth. They're building the business from within, using their expertise in these various areas and so forth. So they have a very strong record of doing that, which is demonstrated in the growth of their dividend. They just raised it another 5%. So
Hmm.
again, depending on how you measure inflation, that's actually faster than most measures, which I consider to be a big positive. And then they also have a very strong credit rating from all the major raters, mid investment grade, A minus, triple B plus. So that means they can go out and raise capital. They can get deals done. They can at good interest, or at least better than the average developer interest rate. So again, a very strong long term record. Number one. Number two, though, it's been beaten down. If someone takes a look at the price chart of this thing, a couple of years ago, it was trading well over $200 a share. Now, even after a pretty nice little run over the past that you mentioned, over the past few months, it's trading around 150. So you're still buying something that, while the Nasdaq and so forth, all these tech stocks have been really staging a late 90s magnitude rally, something that's really been underperforming from that, even though, as you mentioned also, it's outperformed uh, the major REIT indexes this year. I think it's actually kind of easy to outperform those REIT indexes, by the way, because they tend to be really concentrated in the stocks that have done the best most
Mhm.
recently. So I like to find things, like you said, that are unloved. And that means basically people aren't picking over them. People haven't been buying them. People have, in fact, been more selling them. And in fact, a lot of these indexes have been selling them. So I think with this company, I think we're coming into a time when it's going to be doing better and better, and will continue to outperform. And the reason for that is, I think, residential REITs, and particularly Sunbelt REITs in particular, companies that own properties in the Sunbelt, have been people have been kind of thinking too much in terms of an upcoming downturn, like their business uh, is on will see a big decline in income, and I can get into that as well. And I think that's actually the most compelling reason for buying Mid American at this point.
So whenever we buy a stock, we're basically, in a way, it's almost an act of arrogance because you're saying I know something better than the market knows, right? Whenever we do
Right.
that, it's a social
We
science.
are saying that.
Yeah,
Yeah.
and in this case, you're saying the market is overweighting this bad economy. Maybe I'm not trying to put words in your mouth, but maybe the Fed starts, the rates are still high, unemployment rate is going up, the economy softens, people can't afford as much rent, therefore it's bad for these apartment communities. You're saying that's the volume is turned up too loud on that, is that right?
I think so. I think, the other thing that's happened is a lot of people were looking at various data. There's a lot of data on real estate now. Zillow, for example, has a lot of data on new properties and what's available and what prices are they go for and so on. And based on that, there's a thesis that there's a lot of new supply coming on the market in the
Mhm.
Sun Belt, and these other factors that you're talking about, inflation going up, making rents less affordable. And so the thesis has been that this new supply will then it'll force down occupancy rates, force companies to slash rents, and then cuts into income, dividend growth slows. And in the case of a Mid American, no one's expecting a dividend cut, but certainly weaker companies would be in that position. So that's been the theory. But my contention is that what a lot of people have missed is that the fact that the Federal Reserve has kept interest rates where they are has simultaneously discouraged over the past few years new development, as well as people going and buying their own homes. So, in other words, with mortgage rates high, lending costs for developers high, you've seen this new supply, basically whatever's coming on the market is probably going to be the majority of what comes on the market for the next few years, because there hasn't been any new plans. Companies have in fact been slashing. Companies like Mid-American even cutting capital spending, and therefore less stuff coming on the market. And at the same time, I think the other thing that surprised people is all these people coming into the rental market. So this new supply that's come on the market that people thought, and the Fed has said this many times, this new supply is going to drive down rent costs. In fact, rents are still rising, and in fact, all this new supply is being soaked up. Leasing activity is fairly robust. We saw it first happen in some more of the urban areas. Companies like Avalon Bay, for example, which done even better than Mid-American this year. People have said, "Oh, wow, their rents are actually rising and their income's rising, and so forth." And so that stock is turned around very quickly. I think Mid-American will do the same. I think it's starting to, again, because that supply that everybody thought was going to drag the business down, it's being soaked up a lot faster than anybody thinks. So, again, that's the sort of thing I think that if you buy individual stocks and you try to find some alpha in there, that's a benefit you can get that you wouldn't get with the ETF. I mean, the ETF is just going to be, by definition, it's going to be much more heavily weighted to what has been working. And in the REIT sector, not a lot has been working that well, but things like data centers have been doing reasonably well because of the excitement of artificial intelligence and so forth. And a lot of these data centers are seeing they're doing a lot of building. That's gotten people excited. I think there's a flip side to that that's more dangerous, which is they have to spend more money, to get these big centers going, and no one really knows, how much demand will be running through them. So how much money are they going to actually make? But that is what these big ETFs own. So if you take a look at something that somebody doesn't want to own or hasn't, or that's underrepresented in that ETF, and REITs as a asset class are also underrepresented in things like the S&P relative to historical levels. The S&P is about 45%, regardless of how you measure it, in big tech companies. So everything else is much smaller. And in fact, the largest utility in there, NextEra Energy, is doesn't even break the top 50. The largest REIT doesn't break the top 100. So very much underrepresented group. So if the S&P money starts shifting around, goes into the REITs. But I think you can, even before that happens, we can do pretty well with Mid-America, just based on the fact people have really counted it out when the Fed policy actually of higher interest rates has created a pretty bullish situation for them.
And let me just double click on that, because it's a REIT, right? But it's also a dividend stock.
Yes.
And it's very hard to predict Fed rate. Everybody thinks they can predict what the Fed's going to do. It's actually very hard to do it in real life, right?
Yes.
Especially recently. But all that said, what's your outlook for? I mean, it pays almost 4%, 3.85% yield right now, Mid-American. What's your outlook for dividend stocks writ large? Is this a good time, a neutral time, or you just don't know?
I think it's a good time. I think you need to be careful about what you're buying. There are a lot of people are tempted to go for the highest yield out there, and that's usually where most risk is. Sometimes that works, and sometimes whole sectors are valued very low. Like, for example, pipeline companies, I think, there's some tremendous values there, and some yields 7-8% even. But by and large, what I think in this environment investors need to do is who are going to buy, again, going for that extra, that alpha, going for that bigger dividend, that comeback, as we're doing with Mid-American. What they need to do is just make sure that quality, make sure that underlying business is capable of sustaining, not just paying the dividend, but whatever the dividend policy is. I mean, are they raising it? Have they been raising the dividend 5% a year? Can they continue to do that? And I think that's extremely important, because I think the Fed is playing kind of a dangerous game in some ways, in that by keeping interest rates higher for longer. There has been weakness in different parts of the economy. We're seeing it, maybe a little bit now with the employment data. But I think at the end of the day, this Fed follows the market. So I think the main thing they're going to react to will be a major market event. I think this comeback in the NASDAQ has maybe made them a little more complacent and maybe less talking about cutting rates. But the longer borrowing rates are this high, it is having an impact on the real economy. Less capital spending in the more capital intensive areas like real estate. There are exceptions like utilities, which have the benefit of the tax credits and all that they can continue investing in things like renewable energy and so on. But for the most part, you are seeing some the longer rates stay higher, the more likely you're going to see more signs of weakness outside of places like commercial real estate that everybody's looking at right now. So that's very important, I think, to look at the quality, I guess. But I do think that we are reaching a point where the Fed will pivot and we'll see a great rotation, if you will. I mean, there have been a lot of false starts already. Earlier this year, back in January, again in April, and now it's looking like, after this last month, once again, it's a head fake. NASDAQ and big tech again leading the market higher and money coming out of some of these other areas. But I think it will happen eventually, and I think this is a good time to buy and lock in low prices for good companies. Again, with that caveat that they're capable of sustaining their business isn't weakening, that they've adapted, and at least to be able to keep their plans intact in the headwind of this higher for longer interest rates, because it is a headwind. It's a significant headwind.
Yeah, what was it, a week, 10 days ago when the NASDAQ plunged? I think the Dow hit a record high, if I recall. Like, it was like a mini rotation, and then of course it just reversed itself again. I think the market, there are fads in anything to do with humanity, whether it's clothing, whether it's music, whatever, including investing. And we've really been stuck in this kind of big tech mindset for quite a while, and it's probably going to take some time to wash that out. But over time, and you're talking to someone who had a dividend stock service for 10 years. So you're preaching to the choir. I love dividend stocks. Over time, it's just really hard to get away from that mean reversion to companies that actually earn real cash. And because that's what a company's supposed to do at the end of the day, right? Make cash for its owners.
Yeah, exactly. We always, it's just so easy to assume that the current trend is going to remain the trend. I think, and we can talk all day about how people thought that was going to be the case in the late 90s and what happened in the early aughts when you did have that great rotation, and a lot of people just got trampled in it. People that never recovered, lost their whole retirement savings. I think there's a lot of complacency about some potential scenario like that, because for the first time ever, it was more money invested passively in the market through these target funds or ETFs, or just people just throwing their money in there, and as you said, a real binary decision to invest or not to invest. It's basically no differentiation or anything, and there's more money invested that way than there's actively managed. And the money it's passively invested is hugely in these major tech names. It's hugely invested in the current trend. So
it's a closet momentum play. NVIDIA was not long, I don't know what it is now, but 52 times sales. Think about that. If you didn't have any costs at all, it would take you 52 years to get back your investment. Would you ever make an investment? Of course, now the argument is they're going to grow, but at 3 trillion or whatever, how much growth is there? So totally agree with you.
Yeah. So did all the companies back in, that were tearing it up in the late 90s, and many of them have changed it's no exaggeration. It's changed the world completely. But, the success in the stock market had already been achieved. And what was required from that is, I guess, just a great rebalance, and which might be another way of, instead of a great rotation, just call it a rebalance, because it does eventually it will eventually happen. We just don't know when, and I think it's hard to stick with the strategy of buying value at this particular time, just as it was. It's just as hard or harder than it was back in the back in the late 1990s when everybody was talking about new normal.
Yeah, you felt like an idiot being a value investor. Yeah.
Yeah, right. I mean, people got up and said in front of massive crowds of people in 1999, you're an idiot if you're buying stocks for dividends because you can just, buy a growth fund, buy a technology fund basically at the time, and then sell part of it, and that's your income, and you have a lower capital gains rate, which is, it's hard to argue against that, of course, until the cap gains stop coming. So, I mean, I don't want to sound like I'm a doomsayer. I'm really not. I just think that there is, a shift coming, and I've just seen it. You have too. I mean, over year. I mean, anybody just awake and investing over the last 40 years. I mean, it just happens again and again and again. So you just, as investors, really want to be careful that they're not caught up in the gears of it. And chances are everybody's got something that's heavily exposed to NASDAQ, right? If you have any kind of insurance, like, if you have a whole life insurance policy, and you have it in stocks, you're big in tech, with that, which has been good. But, at some point, again, I think having dividend paying stocks and so forth will be an invaluable insurance policy against whatever happens, again providing that those dividends can be sustained.
So if that rebalance, if that rotation happens, Mid-America pays just under a 4% yield now, so that's part of the return right off the bat, above average yield. What kind of upside, if you have an idea, if I'm buying this company for a couple of years, a solid double-digit gain? Is it a double? Do you have any sense of what kind of gain investors might be looking at?
Well, I mean, the stock was trading over 200 just a couple of years, or at the beginning of 2023, which is really when we start this, shift out of everything and into tech. So I think it gets back there easily. I mean, I think a lot, and I think if you look at a lot of the larger REITs across the universe, this is partly a function of how everything's so ETF'd, if you will. These are big REITs, and the more money comes into REIT ETFs and so on. These are the kinds of stocks those ETFs have to own. So, I mean, I think you could get to 200, 250. Now, I will just say that with the caveat that, there is a third possibility of what for the next 12 months, in addition to a rotation or the head fake that we may be seeing now. And that is, a big correction. And, if there is a big sell-off and if tech really gets taken down, it's hard for me to imagine that everything won't take on a little water at some point. Even these stocks that have been unloved, and Mid-America, as you mentioned, has done pretty well this year, and it's outperformed its sector. It's, that gain is pretty much right in line with what the S&P has done. But, money, I think, will come out of pretty much everything if there's a severe enough correction. And, the longer the Fed, I do think the Fed, being the market watchers, which I believe, I think they follow the market far more than anything else. They will act quickly
even though they're kind of not supposed to, but they do.
Yeah, they do. And again, there are people that will disagree with me, and this could be a long argument, but I do think that, I think that's the flip side of it, is that's the one thing they're probably afraid of. And it's not wholly irrational, because we are becoming much more of an investor saver country as this country ages. And, a big wealth effect, there would be a huge wealth effect in the country if the stock market, say, dropped 30%.
Oh yeah.
Which that's not out of the realm of possibility either. So anyway, I think so. But again, with dividend paying stocks like Mid American that are kind of bulletproof against a lot of things. I'm confident in them being able to continue to pay dividends, and these will be the stocks that people start coming back into when the market does rally. So I'm comfortable owning these, even with that possibility of a great correction instead of a great rotation. I mean, obviously hoping for a more benign end to the tech rally, but if that does happen to be the case, then REITs, good high quality REITs, good high quality utilities, things like that. I'm pretty comfortable owning, just from low valuations, but mainly just the nature of their businesses being that they survive the shocks to the economy.
I think you're scaring me into dividend stocks the more you speak, Roger. So if the stock is 152 now and it could go to 200 or 220 or maybe 250 one of these days, on top of what's currently a 3.85% yield, something like that,
Yeah.
that sounds like a pretty good deal to me for Mid America. So I'm definitely going to take a closer look, and I'm guessing a lot of those watching will do as well. Besides Googling MAA and searching further, if they want to learn more about you, Roger Conrad, where on the internet would you send them?
Well, I actually have a column now. I write every week on Substack. So you can just go Dividends with Roger Conrad at substack.com. You can check me out there and sign up. It's just an email, and you get those columns emailed every Sunday. Our company, Capitalist Times, has a number of advisories, one of which is the REIT sheet. So we do cover Mid America as well as about 90 other real estate investment trusts. That's a monthly. We have a more broader based income advisory we call CUI Plus. But then we have some more sector focused publications, Conrad's Utility Investor and Energy and Income Advisor, and they focus on, as the names would indicate, utilities and energy.
Sounds great. You are Mr. Dividend, and we'll put some links up on the screen or in the show notes as well for folks who want to check that out. So, Roger, this has been very informative. I thought you were going to come at me with a utility stock, but you gave a REIT, which is pretty interesting, and I think people watching will think it's pretty interesting as well.
I got to mix you up every now and then.
I appreciate that. Yeah, keep me hopping. So, Roger, thanks for your time very much, and thanks to you guys as always for watching us at home.